Good afternoon, good evening, and welcome to Traders Workshop. I'm your host, Tom Schneider, CMT with NinjaTrader. Traders Workshop, where we bring on our NinjaTrader ecosystem partners to help you give a little bit of insight into the markets as they happen. Before we get into this week's guest, a guest that I love having on, we're going to take care of a bit of housekeeping before we start. I just want to remind everybody that futures and options trading contains substantial risks, not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money that you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results, and that what we talk about here in this program contains neither trade recommendations nor financial advice, but should be used for educational purposes only. And with that, it is my pleasure to welcome back Brent Kochuba from SpotGamma. Brent, how you doing today?
I'm doing really great, thanks. Appreciate you guys having me on. I'm happy to be back and talk options again.
Yeah, no, it's great. It's great. Great to have you back. And I don't know about you, where I am. I'm experiencing a very warm late October day. I was able to get out between the shows, between this morning's show and our show today, and just a nice day, kind of easing into this trading day with this warm weather.
Yeah, sorry, I had a little audio blip there. Yeah, I think we're actually pretty close. You're in Long Island, right? I'm in Connecticut, so it has been nice. I feel like the fall colors this year have been exceptional. And what's kind of interesting is I took the Port Jeff ferry over, which I haven't done, I don't think, ever. And the colors in Long Island are still, you guys are still green over there. I don't know what's going on.
Yeah, one of my things I was hoping to do was even get up and clean out the gutters and, there's nothing's come down yet. It's amazing. It seems like, by now we've got a blanket of, just in time for Halloween, right? But yeah, it is pretty nice. And, we can enjoy the couple of weeks before November comes and everything just turns a little bit. But, it's also been an interesting time. It's kind of a lull in the markets too, I think. I mean, there's certainly activity, but with the Fed meeting next week, we've got GDP this week. It just seems like the beginning of this week a little bit quiet, although maybe the markets aren't agreeing with me. We've seen some volatility these last couple of days.
Yeah, that's an excellent point. I think there are a couple of big events coming up. You have the FOMC, as you mentioned, then we have the midterm elections, which are coming up on the 8th. So, I think we have a couple of days of quiet here before, some of these more macro events kind of pick up. And some of those events actually have a fair amount of volatility assigned to them. Obviously, the FOMC always does. And then, the midterm elections, even though it doesn't seem like there should be much of a market difference or change, there is a little bit of implied volatility tied to those elections. And there's some seasonality associated with this, where markets ironically tend to rally into elections. We put a chart of that up on Twitter before. It's quite a phenomenon, but very strong seasonality, I guess, in this time frame here between literally right now and start of October when those elections take place.
Oh, that's a great point. Real quick, for those of you watching on YouTube, thanks for watching, hitting that thumbs up, subscribing. But if you want to participate in chat, if you have a question for Brent, just feel free to go over to ninjatrader.com/events. There's a chat function there. And, if you put in a question, we'll try to get to it by the end of the show. I think there's a lot to unpack here. So I'm just going to let Brent take over. And I think it's a really interesting topic today. So if you don't mind, this would be great.
Yeah, let's fire away. So when we were on last time, we were talking about the effects of options expiration and some of the ways that it can impact the underlying market. Specifically, generally, we're talking about the S&P and the NASDAQ and the major indices here. So I wanted to start off with our core topics are going to be around these ideas of Vanna and Charm and kind of what those flows can do and how those can interact with the market. But first, we want to stop and give an OPEX update, sort of what we saw happening over the last couple of days. Obviously, all the normal risk disclosures apply here, that this is just research and not trading advice. But first, let's stop off at OPEX. So as everybody knows, last Friday was October monthly options expiration. And this chart, as you can see here, was taken just a couple of days before options expiration. And what we have is the delta notional for put puts and calls for the S&P 500, Spiders, SPX, then you have the NDX and the Q. So it's kind of the big S&P and NASDAQ complex. And what you can see here is that these teal bars are put positions and the darker navy blue bars are call positions, specifically measured as delta notional. So what does that tell us? Well, basically how big were the put positions and the call positions going into last week's expiry? And as you can see, this was a put dominated expiration. Now, some of these puts were possibly short or long, and so you want to kind of net these numbers out a little bit. But the point here is that it is put trading that is dominating this market. And we're at this interesting crux or position right here, right now, actually, in the S&P, where we're kind of trying to flip to like a call-weighted market as opposed to a put-weighted market. And I'll talk about some of the ramifications of that. But basically, over the last kind of 2 weeks, we had put decay, I call it. Puts were destroyed. The value puts were crushed, and that really helped to lead the market to rally up into the 3,700 to 3,750 area. And then we kind of had like a little bit of a pinning. There was a lot of volatility, but ultimately the market didn't go too far at the end of OPEX. And if I flip to an S&P chart here, you can see here that we fed up into this volatility trigger line, we call it, and we could talk about what that is. But basically, this is the equilibrium between where calls and puts, where we have a call-weighted market above this vol trigger line and a put-weighted market below this vol trigger line. And as you can see, right into OPEX, we burned up that put fuel that left us at this equilibrium point. And then what happened is with expiration, all these puts clear out, all the remaining positions that were pinning us in this area of around 37.25, all those are removed, and bam, we've now gapped 1 to 2% higher now. I think in the S&P right now we're around 38.50, so another pretty strong rally today. So the effect of this big options expiration was twofold. One, it crushed put positions, which had the market rally up into OPEX. We pinned in that area for the last 2 days. Now all those positions expire. The OPEX, October OPEX, tongue twister there, those expire. That kind of unpins us a little bit from that trading range, and now we're breaking out. If you look at our subscriber notes here, we say that 3,900 is kind of the next stop for the S&P to the upside. So that's sort of where we stand. Basically, it was put fuel led us up into this rally into last Friday. Those positions all expire, so now we can kind of set a new trading range into some big November events that we're going to talk about.
And this snapshot that you had, Brent, real quick, that's from a couple of days before expiration?
That's exactly right. Yep.
Okay.
And so one of the effects of this, which is a great point I should mention, Tom, is that some of the effects of this, right, they're twofold. It's implied volatility coming down as we pin, but the big one, obviously, when you talk about options expiration, is this idea of charm or time decay. So as every day that we march towards expiration, particularly when you get within a few days of expiration, that time decay picks up, right? And that has an effect on the market. And in general, when you have a lot of puts decaying, right, each day just marching towards expiration, that we believe provides a little bit of a lift. It's a tailwind for equities. And that's because we believe dealers tend to be short puts on net, and that they're hedged with short futures. And so as those short puts lose value, they can buy back futures, and that can lift the market or help support the market.
And real quick, that three-pronged stool, right? You've got time, you've got implied vol, you've got price, you've got two of the prongs falling, right, or getting shorter, so price is compensating.
That's exactly right. And when you don't have any of those variables really changing, kind of let's say last year when you kind of flip to new OPEX and there's not much volatility in the market, underlying price is just kind of hanging around, and you don't get a lot of volatility. But in this case, when you have high implied volatility, with the VIX around 30, you have a lot of put values coming in and moving around, and the underlying price whipping around, that causes a lot of instability in the market. So that's a great point there. Thank you for mentioning that. So we're going to segue today into these two ideas of Vanna and charm. Specifically, what are they, and how you can possibly use these flows to help gain a little bit of edge or just some insights into how the market may trade. Now, implied volatility and time are a little bit different, right, in the way that they move. Time is pretty fixed, right? We know exactly what's going to happen with time. We can mark options expiration on a chart and know sort of when that is going to arrive. Implied volatility, and the idea of Vanna, is a little bit different, right? Because you have to measure, where has volatility been? In other words, what's historical volatility? How much volatility we have? Are there events coming up that traders are worried about and they're positioning for? That can keep implied volatility high. So there's a little bit more analysis sometimes with the implied volatility component. But we want to start with first is the idea of delta. As we all know, we've covered here several times over the past sessions that we've been fortunate enough to be here with you for. Delta is the idea of how many shares are required to hedge an options position. So if you think about an options market maker, dealers, they have large positions that are changing rapidly over the day. Open interest is shifting every day, but they have kind of big headline delta number that they need to hedge, and they'll use oftentimes futures. They'll buy and sell futures to adjust this delta hedge, right? Now, what is Vanna? Well, Vanna tells you how much the delta should change based on how implied volatility is moving. And so if you think about just the VIX, if the VIX is dropping, that's a signal that implied volatility for S&P is changing. So that means the underlying individual options in the S&P are changing, and that all else equal, even if time doesn't change, if the S&P price doesn't change, just implied volatility goes up or down, that changes this delta. In other words, how many shares may have to be bought or sold, right, by a market maker or a dealer. So that then the second one is that we're going to talk about here, obviously, is charm, and charm is the delta change for just time passing. So if we pinned the S&P price at a certain level and we pinned implied volatility at a certain level, as time advances, then that is going to lead to changes in delta hedging levels for an options position. So if you think about a put, right, every day that we march towards expiration, particularly when you only got a couple days left, that put is going to decay very rapidly in value. And so in theory, you don't need as many deltas, right, to hedge that position anymore. So you can change, you can buy or sell more futures as a result. So I want to segue to one quick point here that I mentioned at the bottom, is that this is great as we can use these effects, right, to estimate how much possibly market makers may have to buy or sell and how much that may impact the underlying security. But you also have to have some assumptions around what positioning is, right? If everybody is long calls, like in a GameStop, right, that's going to change what the effect of Vanna and Charm may be, right? Versus if people are all buying puts in a name that that is getting beat up or having a hard time. So you do have to have understanding these effects. Also require you do have a little bit of understanding of how people are positioned in the market. That's something we write about every day in our subscriber notes. But regardless, these sort of positioning assumptions, once you have a handle on how people are positioned, Vanna and Charm can really help you estimate the impact, again, that hedging will have on stocks.
So Brent, real quick, I just want to that point, understanding the positioning, is that something that is readily available? Is it something that is updated? Because updated on a frequent basis, meaning daily? Is it up to date? Is there a lag? How is that determined?
Yeah, so that's a great question. First, at a minimum, it updates every day, particularly for active securities. So you're talking about Teslas and S&P and the Qs. It updates a little bit less often for names that don't have, like a Coca-Cola, right, where the options positions aren't all that active. And then the second phenomenon, which is slightly off topic here, but we've been writing about it a lot. You see it in the Wall Street Journal and Bloomberg and some other news outlets about how much intraday options volume there is now. In fact, there's some we've estimated last week in a few instances where 40% of S&P volume, SPX options volume, is taking place in the contract that expires today. So those positions don't exist at the start of day. People come in, they start buying or selling calls and puts, and then they close those out by the end of the day. So it's kind of day trading volume. So these positioning adjustments have different frequencies to them, and that can affect positioning and what you should look out for as a trader. So it is the positioning estimates sort of, you can look at them on an intraday basis, or if you're a longer term holder or a longer term trader, you can zoom out a little bit and just look at the big OPEX positioning. I think so how much you should care about this depends on how active of a trader, I guess, you are.
Okay.
So the base effects of Vanna and Charm, when we look at how the S&P and the NASDAQ is positioned, is that if implied volatility goes up, we generally think that dealers and market makers have to sell futures as a hedge. That pressures the market down. So the baseline effect that we often talk about, there's a bunch of nuances here, but just sort of the highest level thought process is if implied vol is up, market's going to get pressured down, and that is like VIX up, market down. That's typically what we see, right? And that makes sense. Usually the VIX is spiking and the stock market's going to go down with that, right? And then inversely, if the VIX is dropping like it is today, then the market should be pressured up. Now, there's, again, lots of nuances here. A pure options aficionado is going to have a couple different things to say about this. But obviously, we need to sort of make some baseline assumptions here. So implied vol up, and if you want to use VIX as your barometer there, implied vol up, market down. If implied vol goes down, market goes up. The next thing that we talk about is charm. Now, charm depends a little bit more on how big the positions are in the market and what are they. Are they put controlled markets or are they call controlled markets, right? So right now we would sort of make this estimate, as we just talked about, that over the last couple of weeks we were in a real put dominated market into October options expiration. So if we assume that on net dealers are short puts, as time is passing, all else equal, as time passes, dealers can slowly buy back futures against those short puts, right? Because puts are going to lose value with the passage of time. Now, these charts are assuming everything else is equal, right? We're not changing the underlying S&P price. We're not changing, in the case of Vanna, we're not changing time. And then in terms of the charm chart, we're not changing the price of the S&P or implied volatility. We're just advancing time. What is the net effect of that? And again, if we have a call-dominated market where there's really big call positions, we think the decay of those calls actually leads to a little bit of pressure on the market. And if you think about the behavior of the market, we've talked about here a lot. Last year, it was this effect of pinning into options expirations. That was the well-known trade. The market would pin into these call-heavy expirations, and then we'd kind of unpin. Not totally unlike what happened this last week, but we talked about how much volatility, right, there was in markets. I believe that was last session, right? How much volatility was into OPEX week this year, which has been put-dominated markets. And then what typically happens is the market performs very well after options expiration this year, whereas in previous years it's almost been the opposite effect. So check out that last session. We really cover this put and call dominated market phenomenon closer there. So these are the base effects. Let's dig into this just another level here to really visualize it. So what I've done on your screen here is at the top we've plotted a call option. This is the 3,900 call, and on the bottom we've plotted a put option. This is the 3,700 put. Okay, and all we've done is we made some basic changes to some of these assumptions. So the blue line is 40 days to expiration, right? So an option that has 40 days to expiration, and we have implied volatility at 30. That's fairly high. It's roughly where you can find some of these options contracts right now. And then what we did is with the red line, all we did was drop implied volatility. That's the only change. And what you can see is how much the delta hedge, right, required for this position changes just by changing implied volatility, right? So this blue line, right, if you say, okay, I need 100, let's say 100 futures to hedge with the market at 3,800, if I all I do is drop that implied volatility, then suddenly I only need 50 futures to hedge, right? So you can see here how the position changes, the delta of the position changes when you drop implied volatility. Now, it works a little bit differently, for puts, but it's the same idea here and this is why if you have a put-dominated market or a call-dominated market, you can see what the effects are here, right? On the bottom, if you do the same thing, you have the put and you drop that implied volatility, the delta decreases, right? You go from, again, roughly, let's just say 100 delta put or 75 delta put all the way up to 25 delta put, right? So those are, in other words, dealers could buy back futures in that situation. So you can see how these put values change rather rapidly. And then the same thing here, what we did with charm is that you can see that the red line, or if you want to compare the blue line, either way, but if you have the red line, which is holding implied volatility at 30, if you look at the green line, which is holding implied volatility at 30, but all we did, so the difference between the blue line and the green line is we just advanced time by 20 days. You can see the value of that call dropout, and that value is represented by delta in this case. The delta of that call drops sharply, right? And the same thing with the put, the delta is going to move towards zero, right? And so you can see that if you're hedging, right, if you have 100 shares on at time and time passes, you can see how quickly your hedge ratio would change as a result, right? So you can see these effects and how they come into the market. Now, this is just a single position, obviously, one call versus one put. But if we were to apply a whole portfolio, right, that's changing, the effect is still largely the same, right? Whether you hold one call or 1,000 calls, the effects are going to be really the same. And there's obviously sophisticated tools that market makers and dealers use to monitor their portfolios and play with all these different scenarios. So what happens if implied volatility comes down? How might I have to hedge? What happens as time passes, right? What happens if the S&P goes up a percent or down a percent? They stress test all these portfolio scenarios so that they know that they're covered in any kind of different market move.
Brent, real quick, just to that point, are they adjusting their hedge every day? So assuming everything else is equal,
Intraday, yeah.
Intraday they are, right? So if as time passes, the amount needed to hedge that call position goes down, just if everything else is equal, because time decay. So they're going to tweak it most likely, unless, of course, most likely they're going to tweak it, but it's every day they're doing this. It's not something they're waiting to do at the end of the week or end of the month or at OPEX or whatever.
Yeah, that's 100% right. And I think, if it's a dull day, not much is going on, we're not close to OPEX, maybe they don't have to do anything, right? But the other thing is that these movements all create feedback loops. So obviously, if they have a massive position in the S&P 500 and volatility starts coming down, right? Like the VIX is dropping today, well, they're going to start to buy some futures in theory, right? Because the puts they hold in their account are losing value, right? So it's good for them that they can buy some futures back. Well, if they're buying enough futures, they're going to start to lift the price of the S&P up. And so as they lift the price of the S&P up, they're going to have to make more hedge adjustments, right? And then that will push implied vol further down because the market's rallying and people think, oh, bull market here. I got to get out of these puts. So they form feedback loops. Nothing happens in isolation, but we sort of try to isolate the movement or the hedge changes in these charts here. And so that's where you get the effect or the idea that, hey, look, as you change these positions around, they do create feedback loops. Everything is intertwined in this case. You can't really shift implied volatility and think that the S&P price isn't going to move, right? And you can't drop the S&P by 2% and think that implied vol is not going to spike. Time is obviously a constant, but even the effects of time, that passage of time helps the market to lift, as we kind of showed you in the start here with the OPEX rally, right? When we're looking at, how the market sort of has performed around here. So these are all intertwined, but sometimes, like with implied volatility, the VIX at 30, implied volatility is a really big deal, right? As it comes down in the 20s, that has a much more pronounced effect than obviously time right now, because there's not really any big positions until November OPEX, so we don't really have to talk much about time decay in this scenario. But as we get closer to OPEX, then time decay starts to pick up and is more of an important factor, arguably. So let's shift here and we'll talk quickly about implied volatility. So one of the things I mentioned is, how do you analyze implied volatility? One of the base cases that you start with is realized volatility. And we talked about this on past episodes as well, that realized volatility, in other words, how much the market has moved this year, is sustained at a level that's higher than at any point really in the last 10 years. So this is realized volatility, again, a 1 month measurement. So how much is the market moving on a 30-day basis? You can see right now we are, again, pinned at this level that reaches market realized volatility high or past levels of high. So this is kind of the Volmageddon, is right here. And then you have the end of December 2019 was a really crazy period. This is obviously the COVID crash, which is kind of an outlier. But you can see we've had a lot of sustained volatility, whereas before you kind of get a crash, the Fed comes in and says, hey, here's the Fed put, and the market rallies. We're not getting the Fed put, and so realized volatility is very high. So when you look at realized volatility, which is currently around like a 26, right? That's where we measure it. You can compare that to the VIX, which is currently around 30, and say, well, a lot of people say, well, the VIX is too high right now, or it's not coming down. Well, realized volatility is really high. So it's not necessarily that the VIX is quote unquote overvalued or too high when it's at 30. It's that the amount of volatility we've had in the market is really large. And there's not yet a reason for traders to suddenly think that that is going to change going into the future, right? In these situations where the Fed put comes out, traders go, oh, great, we've all been backstopped now. I think volatility is going to come down a lot. The market is safer. I can start to sell off these puts, or I can, change my position. We're not getting that Fed put, so traders have as much anxiety going forward as they did in the past. We wouldn't have a VIX necessarily at 30 if realized vol was like at 15, right? If realized vol was a 15 over here and the VIX is at 30, then you go, man, something is going on that doesn't make a lot of sense. But with high realized volatility, then you would expect that forward or implied volatility would be very high. And again, this is what you look at the VIX The VIX is a measurement of how much traders are expecting for volatility in the S&P over the next 30 days. And so you can see that's right around a 29 as I snapped this morning. So, this is kind of a fair-ish value, I would say, if you were going to use a terminology like that. And if you use the rule of 16, which is say take the VIX price divided by 16, and that gives you a rough value of how much options traders expect the S&P to move on a one-day basis. So S&P options traders are expecting 1.5-ish% of movement every day in the S&P 500. So again, we've been getting a whole lot of volatility. Traders still expect that to continue going forward. So what that is when you're looking at the Vanna trade, right? If realized volatility was at again 15 and VIX is at 30 right now, you go, okay, there's a ton of implied volatility in here, and that effect could really have a pronounced impact on the market, right? Implied volatility could really drop very sharply now, right? As a result, if we just had a certain scare, right, in a normal environment, then you go, okay, that's the potential impact of Vanna in that situation would be really high. If implied volatility suddenly collapses, right? The VIX suddenly goes from 30 down to 15. So in this case, regardless, when implied volatility comes down, right, if it starts to drift lower, then that should be a lever for the market to move up. So if you think about dealers being short puts, if volatility comes down, as we just showed in this chart here, if implied volatility comes down, then that means that dealers need less futures, right? Less short futures, so they can start to buy those futures back, and that adds a tailwind to markets. Conversely, if the VIX suddenly jumps to 50, puts gain a lot of value, and dealers have to sell more futures in order to keep themselves hedged. So that's why if you're a futures trader, you don't really watch the options market, this is what the VIX kind of can help you do, right? VIX coming down is a positive signal for equities because it implies that dealers will have to start buying back futures as part of the Vanna component of hedging or trading. And conversely, if we see the VIX start to ratchet up, right, then that's telling us that we may see selling pressure come into the equities because of the fact that higher implied volatility may mean that dealers have to start selling futures off. And it's also, just as a note on the VIX, it's a barometer for what's happening in the market. If traders are buying, generally if they're buying puts, that tells us that they have a bearish outlook, right? You're concerned, you want to buy a hedge. It's just kind of just a sentiment check sometimes as well, as a note, right? And if the VIX is coming down, well, traders are probably selling puts and offloading those. There has been a couple of interesting, I don't want to overcomplicate the discussion here, but there's been a few instances lately where the VIX is up with the market up, and in general that tells us that traders are buying calls, and that is generally generally a bullish signal in that case, right? It kind of flips some of these metrics on their head a little bit, but you don't often have sustained levels of VIX up, market up. That's generally showing some euphoria, which can be sort of an excessively bullish signal. However, if you look at some metrics like a GameStop, you can have like a GameStop implied volatility can be going through the roof because people are buying so many calls, right? That those stocks will like actually crash up, right? So obviously VIX usually goes up when the S&P drops, but in some certain single stocks where there's real frothy excessive call buying, you can actually have implied volatility go up very sharply as the stock is going up.
So Brent, you've said a lot there, and there's so much to unpack, and I think it's a great explanation. I'll get to that in just a moment. Jim and I talk about, since, let's say, November, Thanksgiving, I think is the day he uses. But since after Thanksgiving, we've seen these bigger moves during, just in the day, right? Mm-hmm. And you can see it here with the volatility. Do you have an idea, or do you care, right? Do you care is the first one, but do you have an idea of why that might be? Is it a result of the inflationary environment that we're in? Is it a result of the uncertainty that we're in? Uncertainty comes to mind just because it's volatility, but what, in your estimation, do you have an idea of what that might be? Why we're so volatile, 2% daily on the day versus what might have been normal before, which was 1% or so. What are your thoughts on that?
Yeah. So this put-dominated market that we've talked about before, and I was going to touch on this briefly here, but we have this metric called gamma tilt, and what this shows you is the ratio of put gamma relative to call gamma. So it's basically telling us how big are put positions relative to call positions. And so earlier I touched on this idea that we're in a put-dominated market, and therefore the hedging flows tied to changes in implied volatility are very high. Traders tend to more actively trade put positions because of the fact that they're tied to implied volatility. And so you have very large options positions constantly being added and removed, right, and adjusted very frequently. And that is tied to volatility. And if you, we again had that slide in the previous presentation about how how the market has moved so violently down into OPEX this year and moved up after, right? And a lot of that we believe is put positioning. And so these big puts are causing a lot of chaos because of the fact that they have to be so actively traded. And we think that in general, until the Fed stops hiking rates, until they pause, that volatility is going to persist. Because ultimately everything is driven by the fact that no one can understand or know the forward path of interest rates. And if you don't know what interest rates are, where interest rates are headed, then you can't price equities. You basically can't price anything. So the whole, financial markets in kind of turmoil because of the fact that no one even knows what should they expect with short-term rates. So that's why the jobs matter. That's why the CPI prints are so impactful now, right? Because of the fact that everyone's trying to get a handle on how many hikes are going to come and when the pause is going to happen. And we think until there's a pause, you're going to keep getting larger put positions in the market. Once that pause happens, then we think that this put and call equilibrium will balance out a little bit. To that point, here is the end of January, right, and all-time highs. And you can see that this tilt indicator, which used to be up around kind of this 1.2 to 1.8 area, this whole year it's been down in this 0.5 to 1.2 area. So this is telling us that put positions relative to calls have been much larger in the market. And that is the dominant sort of flow. And as you can see, these puts will expire generally with expiration, and we'll get a relief here where the put and call equilibrium bounce out, and that's associated with market rallies, right? And it's actually kind of a leading indicator, as you can see on your chart here. With October options expiration, that this metric has jumped higher again because a lot of puts expire, a lot of puts decayed, and so now that we've shifted more towards a balanced equilibrium, so to speak.
And equilibrium here on this chart, would that be one? Would that be like a 1-to-1?
Yeah,
or am I thinking of it differently?
No, that's exactly right. It's just a ratio, yeah. And
Sure.
so we have this other metric here that we call our vol trigger, and the vol trigger is actually where we see that equilibrium, the specific strike at which we see this equilibrium taking place. And so often, as you'll see, the idea is that when the market is below this vol trigger level, which is green, there's higher volatility in the market because that is the area where put values spike higher, where put positions build, and that is what leads to the volatility. And as you can see this year, over the last couple of weeks, we had the market drop pretty sharply here. And then there was one interesting period in August where call positions really built up in the market. And you can see the black line going over this green line is telling us that calls built up in the market. And with that, we had a really nice rally from basically from July OPEX up until August OPEX, right? And then in August OPEX, a whole lot of calls were wiped out of the market, and then the market dropped, right? So we had that inverse relationship. And the other thing you can see here is that a lot of times the market will deviate from this equilibrium, will shift to the equilibrium where puts are burned up, and then the market rally stalls. And that's one of the things we're worried about with this current rally, is that the equilibrium today was right around 37.50, right? And so we kind of the market rallied hard into that area, and then we've stalled, right? And the idea is that, well, put values have been crushed, but now we need call buyers to help us get the second leg of the rally, right? So in other words, for this August rally to continue, you could see that we had to get over that vol trigger, which shows, okay, puts were used up. Now we need calls to pick up the baton, and that happened in August for the first time this year. But then since August, we've not been able to get any real call positions built up in the market. So this is a similar thing. Put values get crushed, which brings the market up. But now we need call positions to come into the market, and we're starting to get that percolating a little bit. But this is that shift in equilibrium from sort of put market to call market. Right now, we need a call market. We need call positions to pick up to keep that rally going. So that was, the idea of how Vanna implied volatility affect the market. We kind of jumped a little bit ahead, not really ahead. We just had a great segue, obviously, to this idea of put or call controlled markets, and how that can impact the market, and how those flows can impact the market. And the idea is, with the idea, why do I want to see a calls come into the market to keep the rally going versus puts? Well, if you look at this first chart here, right, as the market increases in value, right? If we were down at 3,700 today, right, and implied volatility was getting crushed, we would have the market rally, right? But then as you can see in the blue line, eventually the delta of these puts shifts to zero. So the hedging flows tied to these puts shift to zero because the puts are so far out of the money now, right? And so if you are believing that, okay, a dealer had to sell 50 shares to hedge the blue line here at 3,700, then at 3,800 they only need 25 shares, then at 3,900 or 4,000 they need 0 shares, right? Then if the market continues to go higher, well, they don't have any shares to buy back anymore, right? Because the put is worthless. So that's why the rally stops when we hit that vol trigger equilibrium point, because the delta hedges from puts in theory are worn out, right? They're burned up. So all that sort of short cover hedging effect is gone. Whereas with calls, if traders are long calls, you can see that the delta increases as the market goes up. So in theory, if dealers are short calls, right, they have to buy stock as a hedge. And then as the market goes higher and higher and higher, they have to buy increasingly larger numbers of shares. And that could spur the rally forward, right? That keeps the rally going. So again, with put controlled markets, the puts decay, the delta goes to zero, and then they're done buying. Whereas if we can get call buying going on now, right, then as the market goes up, dealers have to buy more and more shares of stock or more futures, and that increases, that helps the market tailwind continue, right? That will continue to drive the market forward. So those are sort of the key points. I don't know if you have any questions or anything you want to touch on, but those are the key ideas of again, Vanna and Charm. That we've got sort of prepared here. And again, we're at this equilibrium right now. We talked about it in our subscriber note that this morning that, 3,800, we got to get a close above that, and we need to see call open interest increase. We want to see this delta tilt number continue to shift higher. That tells us that call gamma is coming into the market, and that will continue to keep the tailwind. And then I should segue. I guess I forgot to mention this one thing. There are two big events coming up: FOMC and the election. There's some GDP prints and there's some other macro data points coming up, but the big one is FOMC right on the 3rd, and then the elections on the 8th. Implied volatility is going to hold. The VIX is going to hold a premium because of how close the FOMC is, right? And if the FOMC comes out and gives any kind of hint of a pause or accommodative policy, anything like that, then implied volatility will collapse, right? And that would indicate that the market's really going to jump higher. And so there's this interesting synergy of sort of time, right, where we have the 3,900 call wall as the top of our resistance line, and we're only about 1% away at the moment from that level, I believe. And we're going to pull into this time where the market's going to get pinned up, I think, until 11.3 FOMC goes away, and that's where this Vanna trade really could kick in, because either implied volatility is either going to jump after the FOMC or it's going to tank after the FOMC, and with that, the market will respond in kind, and could really unlock, a new wave of hedging flow. So all else equal right now, positive drift, as long as we're over 3,800, positive drift is in control, and that should be a bullish signal up until we get around 11.3 FOMC, where we're probably likely to pin or stall because traders are going to be waiting for the FOMC.
So a couple questions, Brent, or maybe one point and one question. I think this is where on the FOMC day, I've just kind of learned 2 p.m. Wednesday, FOMC, clear your schedule, don't have any meetings, be aware of this number. And, but really, I think this year it'll be, or this meeting, 2:30 is really the time, right? When, we kind of know that 75 basis points is baked in, given any kind of, unusual report until then. But it's really, like you said, it's when they give direction, what is implied, when are they going to stop, when are they going to stop raising rates? Is it going to be March of next year? Is it going to be June of next year? Anywhere in between there. And so, my point is, 2 o'clock, okay, we'll get that number, but 2:30, I think, is where the real fun begins, because that's where we get a little bit of a guidance. And that's where, I think you might see the market really move, especially if they're trying to figure out what's happening next meeting, what's happening in the end of the year, what's happening in first quarter, second quarter next year.
Right. Yeah, I would totally agree with that. And, there is this kind of lower bound, I think, for volatility of the VIX right now, right, where we could kind of get down maybe to 25 in a really bullish scenario, but ultimately we can't get a complete sort of release until the FOMC passes, right? And who knows what we'll get with FOMC. There's the news, and then there's the reaction to the news, and the two sometimes just don't always seem to line up. So that is the big event, and I think again, there are traders who say, well, great, I can sell volatility that expires, short dated options, because the FOMC is not until the next week. I got 10 days to do what I want here, sell next week's vol, or sell Friday's puts, or whatever. And so this rally right now can continue a little bit, but that will slow down, I think, as we get into the FOMC.
And my question to you would be, because you mentioned two events, right? You have the FOMC on the 2nd, and then of course midterm elections on the 8th. What do you think is more impactful?
The FOMC for sure. I mean, this is only the midterm elections. I think in general, people hedge the elections, and I just remember with Trump, right? When Trump got elected the first time, the futures were down, I don't know, like limit down. And then by the next morning, they were like all the way back up. And so it's like, these events are always hedged, but how fast can policy change, regardless of whether Republicans or Democrats walk away, with more seats or whatever it may be? The short-term impacts of those things, I think, are very, very small. And so there's always this implied volatility premium around the elections, and I think it's because of the chance of some kind of crazy outlier event, like who knows what can happen this day and age, right?
Right.
So if elections just go off relatively clean, and people are more or less okay with the results, and that it wasn't, the politics are always a touchy subject, but in general, assuming elections go off fine without a hitch, regardless of whether Democrats or Republican wins, I think vol will come down after the event, and that's a tailwind for markets. So now again, if Powell comes out on the 3rd and is like, look, I'm going to raise 500 basis points in December, well, it doesn't matter what happens in the elections, because there's going to be smoke and fire everywhere. So
for sure.
Yeah. So I kind of lumped those two events a little bit together. But if Powell's happy, or appeases the market at all, we're going to rally. Implied volatility is going to drop, and then you're going to get kind of like a kicker if the elections, 99.9% elections probably go off fine, and the implied volatility just drops a little bit, as a result.
Question from a viewer, Mike K, has a question for you, Brent. Are put call numbers proprietary information, or are they available from the exchange? How does that work?
Yeah, you can look at put call ratios, which give you a flavor for what's going on. The problem when you look at put call ratios is that the open interest isn't weighted at all, right? So you could have calls that are 5,000% out of the money, and a put call ratio will weigh those equally against like a put and at the money put, right? So that's why we use gamma, because gamma is a weighting effect. Gamma is highest for options that are at the money and closer term and expiration. So they're a little more relevant from a hedging perspective. That's why we essentially built this tilt indicator, which is basically a gamma weighted put call ratio. There's a couple of we offer this number for our subscribers. There's a few places out there that'll teach you how to kind of measure this if you want to do it yourself. But in general, this would rhyme with a put call indicator or a PC
awesome
ratio.
Thanks. Thanks, and thanks, Mike K, for putting that in there. Appreciate you being here and interacting with us and throwing your questions in there. Brent, I think we're running up against time, so I want to give you plenty of opportunity to, where can people find you? Where can they continue the conversation and learn more about this?
Yeah, thank you so much. You can find us at SpotGamma on Twitter. If you go to SpotGamma.com, you can get a free 7-day trial of our daily newsletter. And we have a bunch of different metrics to analyze the market, both sort of from day-to-day basis and month-to-month, but also real-time. We have a real-time indicator, which is quite helpful, and a lot of feature shares like that. So you can check that out at SpotGamma.com.
Awesome. Brent, thanks so much. Thanks for being here and giving us your time and your wealth of education. And we were talking before the show, saw your name in the Wall Street Journal, so it's big time here at Traders Workshop. I get the print copy. I don't get the online copy. My wife has that login and password, and she uses it at work, so I might get it a day later. But really good to see your name there, and hopefully the continued success is there for you. It's wonderful work that you're doing. So thanks again for being here.
Yeah, well, thank you for the opportunity to come on and talk to everybody, and it's a great platform, and so I'm very grateful for that.
Awesome, thanks, Brent, and thanks to you, the viewers, for being here as well. Really appreciate you all being here. We do it for you. Just want to remind everybody, We will be having the bars closing as usual. No reason not to, right? 3:15 Eastern time. And until then, have a great trading day.